an AUM of nearly $160 billion. It's one of the biggest names in the space that he says is disrupting traditional banking amid tighter lending conditions. With us here at Post 9 is Blue Owl Capital co-CEO Marc Lipschultz. It's good to have you back on.
Thank you. Good to be here, particularly on National Peppermint Bark Day, I found out.
National Peppermint Bark. Yeah,
Peppermint
I saw
Bark.
William Sonoma handing it out. It's the holidays here at the New York Stock
Does anybody
Exchange.
know when National Direct Lending Day is?
You can
Let's
spearhead
make that a thing. Or maybe not, Mark, because everybody and their mother is getting into the business. How's the competition affecting the overall landscape?
The overall market for direct lending is really good today. At the end of the day, it's about supply and demand. And while it is true, there have been new entrants, and there always will be new entrants in the innovative capital markets. At the large end of the market where we focus on the biggest credits, it's really the same handful of key providers. And in fact, I guess I say key providers in so much as over the last couple of years, were it not for lenders like Blue Owl, there really almost be no debt capital market. So it's a good time. The companies that we're seeing are really high quality, and most importantly, our portfolio companies are performing really well, which is a reflection of the economy.
That's what I was going to ask you, is what the corporate performance of your underlying companies are showing right now, positive and negative.
Yeah, so overall, it's really great. If you look over the last quarter, we have about 350 companies in our portfolio, so it's pretty broad. Now we concentrate in particularly what we would consider high-quality, durable sectors, a lot with software and healthcare. But our portfolio, on average, portfolio company grew revenue 10% and EBITDA 10%. I mean, those are really healthy numbers, and we're not seeing a meaningful change in forward indicators of problems to come, things like people asking for more amendments or asking to pay in kind instead of cash their loans, which would be sort of necessary things to happen before a meaningful issue in the economy or in the credit market, and we don't see that.
You've been great at the retail distribution and private debt, but are you exhausting those deals? Is there room for growth at these kind of levels?
There is room for growth, and I think that's more about ultimately the return of the M&A market. So while it is true that today direct lenders, and Blue Owl in particular, we have a very large market share, it's of a much shrunken market, right? M&A activity in total is much more muted. So as that market comes back to supply and demand, that's the demand equation. And when you consider the $1.5 trillion of dry powder in the hands of private equity, or the family businesses that used to rely on the regional banking system and come to us instead, there's really a lot of structural demand going forward.
You do mention the supply aspect, and that maybe the capital markets wouldn't even be functioning properly if not for players like you. That's obviously banks are smaller than they used to be in this area. They're a little more constrained. But just exactly how can the returns hold up when there are many more people? Because, we talk about, the UBS chair saying that it's a building bubble in private credit. I think people wonder just why those returns should be available. So attractive on paper if you're not taking more risk.
The key to generating a return is delivering value. Right? At the end of the day, we get paid by the borrower for something that really is useful to them. We deliver three things. We deliver predictable financing solutions. We deliver private financing solutions so they can really think long-term. Right? We have long-term capital for their long-term needs, and we deliver a partnership. They know who their lenders are. Go back, and I've been in the alternative investment business for nearly 30 years, before it was called alternative investments. And for all that time, go back 30 years, we used to know who our lenders were. And when times change, for better or worse, that is valuable. And we're delivering that partnership, and that's what we're getting paid for. And it isn't just the market, because you're going to care who your lender is. It matters who you're dealing with when times change. And that's really how Blue Owl, we've been able to help move this market from roughly a decade ago being the lender of last resort to the lender of first choice for some of the very biggest and best companies in the country.
You were talking about the good corporate health of some of your underlying companies. Is it because you've positioned more defensively in this environment? And if so, if we're done with tightening, do you change the strategy or the type of sectors that you lend to?
So we definitely have positioned, I would call it, defensively would be one term. The alternative would be durably, which at the end of the day in the credit business, it's all about credit. We've looked at over 8,000 companies to make the 500 loans we've made. We've made $80 billion in loans over the last 8 years, and our running loss rate has been 6 basis points. And in software, where we're the market leader, we've had 0 losses. So it is about durability and, yes, an element of defensibility. No, I don't see change in that strategy. We're all about protecting the capital first and foremost and generating an attractive return to go with that. And, Mike, as you said, returns are very compelling.
Across sectors?
Well, we certainly prefer those durable sectors.
Yeah.
Again,
what does that mean? What's a durable sector?
Well, it really means a sector that is going to be insulated from the economy, insulated from geopolitical, uncertainty would understate the case, geopolitical volatility. So businesses, again, like healthcare, businesses like software, they don't have that susceptibility to those changes, and they don't have large CapEx requirements. So you also have a lot of cash flow to work with. That's good as a lender.
You talk about the dry powder on the books of private equity players, and it's been that way for a while. You know, if I look at a small cap index, it would seem like there's a lot of cheap stuff out there. In fact, one of the first questions you might ask the IR people from some beaten up, you know, smaller micro cap company is, why isn't private equity bought you yet? So why isn't there more activity? Is it just the hurdle rate where actual financing rates are right now, or other factors?
I think at the end of the day, it is this uncertainty in the world that is suppressing overall activity. It's hard to be boldly bullish today, right? I would think, listen, I live in a world where it's always good to be cautious. We're in the lending business. We do triple net lease real estate, very defensive strategies. So I live in a cautious world. But with that said, it'd be hard to construct the case for why now would be the time to go out and be a swashbuckling risk taker. And so I think it's dampening, it's tempering equity interest, but that equity will come. And that marketplace, those underserved small cap public companies, even the larger ones, are going private, right? We've seen this continued long-term trend out of the private market, out of the public market, into the private market, and I think it's going to continue.
Mike referenced the Colm Kelleher comments from the chairman of UBS saying that private credit's in a bubble. Is it?
So, look, Colm is a great executive, and we do a lot of business with UBS. Private credit is not in a bubble. Private credit is in a stable place. Period, full stop. That doesn't mean there won't be loans that go bad. Of course there'll be loans that go bad. But here's the beauty of private credit. We have long-dated capital. We make long-dated loans for people to build their businesses over the long term. And so it's stable. It's not systematic. We're not tied to anybody else. So let me ask you this. Over the last 2 years, there was essentially no banking or functioning liquid markets. Are we better for having a private market that stepped in and allowed people to still build factories and hire people? I'm quite sure we are.
But does that need to be regulated, is a question?
No.
Because, you know, some will say it's happening in the shadow banking area, and we don't know what the risks are.
It doesn't need to be regulated. First of all, it already is. People like ourselves work closely with the SEC. But here's the thing. We don't connect to the rest of the system. We use very little leverage. On average, use 1 turn of leverage in our books. Very, very different. Right. And this shadow banking term, and we understand why people use pejorative terms, there's nothing shadowy about it. Do you know we disclose every loan line item every quarter? And in fact, if you want to sacrifice your ratings, I'm happy to come back. We can spend an hour and go through every loan we have. I doubt you'll get that offer from most of the banks.
But they're not funded by, like, the low-cost consumer deposits.
That's right.
Regulators
we don't have deposits. Yeah. We and our institutional investors, we bear that long-term decision and that long-term risk and opportunity.
It's a good deep dive. Always like having you, Mark. Thank you.
Thank you so much.
So
Great
committed
being
to
here.
that dividend, dollar per share?
Game on.
I ask you every time.
Game
on. Thank you.
on.
Marc Lipschultz, Blue Owl Capital.
The IGV software ETF closing at a 52-week high yesterday, coming off its best month in 21 years. So can it keep up the momentum into the new year?